So when you hear questions, if you're out and you're talking to the community, you're talking to legislators about, we can't sustain this, it's going to cost taxpayers a significant amount of money. The bulk of the cost for the benefit comes from investment returns and your contributions. 75% of what we pay out is coming from what we make on investments and what you contribute. The taxpayer portion is only 25% of that benefit. We are funded. We can actually go down to a lower rate of return, and we would be able to sustain this fund beyond the year 2000 and 2100. They didn't even look beyond that, but we could sustain it now beyond 2100. So the fund is not in trouble. In May, we achieved an all-time asset high of over $12.2 billion. That raised our funded status. Funded status is something that the legislature is very concerned about, and I'll get to a slide later that talks about when it was low. But our funded status at June 30th was 90.2%. What that means is we had 90.2% of the money needed to pay all future benefits. And what that means is we anticipate you're going to continue to get pay raises, and we are projecting that you're going to be making a significant more amount of money than you are today, and that's what your benefit's going to be based off of. And we have 90.2% of the money we need to pay every benefit for every member till the day they die. Today, we have that. Now, not everybody's going to quit contributing. We're not going to quit making money, so we're very solidly funded. Some of the other factors that help us and make us different from other pension systems, our retirement system does not offer health care for retirees. That's a big issue for some retirement systems. Now, not that we don't wish we did, but the fact that we don't helps. Our benefit is the 11th lowest in the nation. And the most important issue, and this is what I keep telling legislators, ever since PERSI was developed, the legislature has mandated an ongoing revenue stream whenever a benefit enhancement occurred. And because of that, we're in good shape. Not all states did that. As a matter of fact, many of them, back when the markets were good in the early 2000s and mid-2000s, they enhanced benefits for their retirees without any ongoing revenue stream. They just assumed they could continue to make 20% a year in the stock market, and when they couldn't, they had no way to fund those benefit enhancements. We have never done that, and a lot of the credit for that goes to the legislature. A lot of times we talk about them trying to take benefits away or whatever, but they've made this plan sustainable. All right, next slide. This shows you a 3-year history of our funded status. Back in 2009, if you remember when I came here and talked to you, we had went through what we called the Great Recession. Our funded status was down to 74.1%. Many people at the Capitol were very concerned about that. We were not overly concerned because we know we can bounce back quickly. And as you've seen, and I kept telling people, it'll be okay. They were having a hard time believing me in 2009, but if you look at the bottom column there at the 90.2%, our unfunded liability is an amortization period of 8.2 years, which is really not very much. 1.3 billion sounds significant, but this will give you a little bit of perspective. I think it was in December, the Idaho Freedom Foundation and the Idaho Reporter ran a news story that we had given a COLA to retirees, and we were down from last year's total. We were down $662 million. How could we give a COLA? And I'll go back here real quick. Today, we are up $152 million. So since December, we've made about $800 million. Okay, so that's how quickly things can change for us. All right, this next slide, I'm going to talk, this is real important because this is part of the national rhetoric and what you may hear again in Idaho, they're wanting to change pension systems because they say that they cannot be sustainable at the assumed rate of return that these systems have, all right? Most systems have a assumed rate of return somewhere between 7% and 8.5%. PERSI's is 7.25%. That's what we think we can make every year in the stock market, and if we do, it keeps us at even keel with the fund. And a lot of times I'm asked, well, why do you think you can do that? And people will take a number of different averages. You can do anything to prove a point. You know, I just have to figure out which ones prove the point I want and include them in there. But as you can see, everything in green is positive numbers. The majority of those numbers are over 7.25%. The most important number up there is the 46 average. Year average. So since PERSI has been in development, we've averaged 8.31% returns. So we're a little over 1% above what we assume. There is no reason for us to think that we can't make 7.25% annually on an average. Okay? If you look, and we look long term, we look 20, 30 years. I have no doubt for the next 20 or 30 years we can make 7.25%. We'll probably make more than that, but. PERSI is in very good shape, and there's no reason for us to be worried about it. Next slide, Melody. This shows you what we did last year. Last fiscal year was the highest return we've had in 25 years. We made 20.7%. If you look at the second bold number there, that's how much money we made in fiscal year 2011. We made $1,898,000,000. So we had a relatively good year. The next slide, this shows you where we are today. So for the fiscal year to date, we've made $152 million. We're not back to our all-time high, and I'll talk a little bit about what's happened since June 30th. But this will allow us, right now our funded ratio is 88.3%. So it's down about 2% from where we were at the end of the year. And considering the volatility of the market, that's pretty good. So we're not too worried about that. So what's happened? What caused us to take a dip down? As you've watched the paper, there's a lot of issues going on. The way the Congress handled the debt issue was part of it. The current election is part of this. I'm actually surprised you're seeing the market go up with the election. I thought it would stay fairly stable until after the election. However, that's happened. There are a lot of issues in Europe that are affecting the markets and will continue to affect the market. Some people wish we were a national market or a national economy. You know, the reality of it is from now on it's a world economy. We're going to be affected by what happens all over the world. Standard & Poor's downgraded a lot of stuff. They downgraded U.S. bonds, and what's interesting, since they downgraded U.S. bonds, that's one of the highest returns in the market. So everybody thought that would have a huge impact, and it really hasn't. People who stayed in bonds have made a lot of money.